Now let's get back to our other top story. Of course, the Fed delivered its fourth straight rate hold in an expected decision yesterday, and the median dot plot projection continued to show policymakers expecting 2 rate cuts this year, but there were increasing signs of a split, with 7 officials expecting rates to stay on hold for the rest of the year, up from 4 when projections were last offered in March. In updated economic forecasts, policymakers downgraded their outlook for growth this year and signaled they now expect inflation of 3%, up from the 2.7% projected in March. Now, those projections raised concerns around possible stagflation, with Chair Jerome Powell warning that tariffs will hit the outlook for inflation and have stopped the Fed from cutting rates.
What we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs. Ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And we got further clues on the Fed's thinking in its statement announcing the decision. It said that uncertainty around the economic outlook has diminished, even though it does remain elevated. Now, compare that with May. That was when officials said uncertainty about the path for unemployment and inflation was actually increasing. Now, another line from the Fed's May statement disappeared this time around. Officials no longer saying explicitly that the risks of higher unemployment and higher inflation are rising.